All right, good afternoon. If you weren't here in the morning session, I'll reintroduce myself. I'm Allison Watson with Faegre Baker Daniels, and I'm serving as the MC for this session 2 room. And so we'll kick off the afternoon with Guy Fraker, Chief Innovation Officer for the Insurance Thought Leadership. Guy has more than 30 years within the insurance industry. In his capacity as Chief Innovation Officer, Guy leads ITL's Innovator Studio, which serves insurance companies, regulators, reinsurance firms by helping them leverage consistent innovation for long-term leadership, growth, and stability. And joining him on the panel is Matt Gabriel. Matt leads John Hancock's life insurance innovation and advanced analytics teams, where he drives the technical aspects of their most innovative projects. In these projects, they require leading across the emerging intersection of pricing, underwriting, and analytics. So thank you, gentlemen, and I'll turn it over to you.
All right. Thank you very much. I have to tell you, I get kind of warm and fuzzy sitting up here in airplane seats. 2009, I was flying back from California to Illinois, Bloomington at the time, having taken my first ride in a fully autonomous vehicle. And this guy sitting next to me on an airplane pops open his laptop and drops in a disc, and he's watching videos of self-driving cars, which were not as well known then as we know now. And it turned out he lived 25 miles away from me. And then after that, we spent 8 years working together on getting those cars out onto the market. So this is fond memories, kind of sitting up here like this, as long as you don't count red-eye flights. When Kay called me and asked if I wanted to be in a discussion about wearables, my immediate reaction to her was, in the body or out of the body? And she laughed and said, well, I don't think we want to constrain you. I could tell that she'd still been stewing on that about a week later. Matthew's got a very interesting story to tell, and I don't want to get in the way of that. So to kick this off, Matthew, why don't you talk a little bit about the Vitality Program at Hancock and how you came about deciding this was a path to go down.
Sure. So we have a very innovative product at John Hancock with our life insurance products. Basically, as part of the product offering, we put people into a wellness program. It's really about shared value between both us and our customers. So if we can get them to live longer, healthier lives, we benefit, delaying the time it takes for us to pay a claim. They live a longer, healthier life, so they benefit as well. So we're really looking for ways to drive these shared valued relationships, create a rewarding and engaging ownership experience for our customers where they're not just getting their policy, throwing it in a drawer for their beneficiaries to find 40 or 50 years later. We're talking to our customers 20, 30 times a month. It's a totally different type of interaction. It's not about a complaint or an issue, but it's really focused on creating this meaningful connection to them.
When we were talking before, you made an interesting comment about in a life insurance, in the life cycle of a life insurance policy, if you will, when the actual policyholder is engaged and is not engaged, which is far different, of course, from the property and casualty. Do you recall what you said? Because I thought it was brilliant.
Maybe I don't know exactly what I said, but I think creating that rewarding.
One of the insurance policies where the policyholder is not around for the claim.
Yeah. I mean, that's the thing is the policyholder won't even be there to deal with the company with the claim. Their only experience with us is when they buy the policy and maybe when they pay their premiums, or if something goes wrong, especially on the life side. It's not like you said with P&C where they're going to actually go through the claims process. So creating this engaging touch point, it allows you to move them into other products to really make sure that as they age, as they see, as they go through life events and changes, that we can come back to them with additional offerings and really be a partner in protecting their financial security.
There's, I think, a perception out there that we talked about a little bit that wearables were the human side of telematics. And a lot of companies have really struggled. There was a time when I would get a call a week from a telematics startup saying, we have the greatest thing in the world. I don't understand why we're not getting adoption by the insurance industry. And as many people know, by having it be voluntary, it became somewhat of a loss leader and a struggle for many of the property and casualty insurers that have used it. How do you see wearables as not being just another version of telematics?
When I think about, I mean, we could go through this whole presentation without even mentioning wearables. It's really about creating that experience and incentivize healthy living, healthy attributes, things that can help you live longer. Wearables is one part of that. We do biometric checks. We do education. We encourage regular doctor's visits, preventative care, all of that stuff. Wearables is one thing. I mean, exercise is very important. I think we're at a point now where we've never really understood how important both exercise and diet are to living a healthy life. There's a whole bunch of more science coming, I'm sure, in the next 10 years around that. We'll see dramatic changes in life expectancy. So it's much less about the wearable and much more about the program, incentivizing good behavior, getting people to engage with you on a frequent basis so that they stay connected with the program. You can actually deliver that content to them. But also, in some ways, having the penalties for not engaging, whether that's, an increase in their charges or premiums or things like that, that's what gets people to come back and engage. And there's proven, behavioral economics research out there to help guide that. I don't think a lot of the early telematics programs had any of that in their offering. They just said, hey, plug this thing in and you might get lower premiums. And It's a very different, having a full program around it versus a device is a very different experience for the customer.
Yeah, I think a key for what's different with the wearables in the insurance industry is that there is both the carrot and the stick. And so it isn't just about the collection of data. You also talked about the benefits to John Hancock from having people live longer. And that was part of your business model when you
it's
decided
having
to go
people
into
live
this?
longer. There is some aspect of positive selection, I'm sure, but it's really that if you can change people's behavior, if you can incentivize those behavioral changes, you can change the outcomes of the mortality outcomes that you expect. And you can also then have a rewarding and engaged customer base to upsell, cross-sell into other product offerings. So all of that factors into the business case.
Yeah, there are, as you know, thousands of wearable devices out there. And in some countries, it does involve being under the skin. There are chip implants that have been connected to workers' comp and loss ratios. Then there are the more traditional wearable devices. You're starting out with the Fitbit and a company that resides where? Your partner in this?
So we work closely with a South African insurance company, Discovery in South Africa. They've done a lot of really cool things. And they actually had originally built this Vitality program, rolled it out there. They've rolled it out in the UK, and we're in their exclusive US partner and Canadian partner between Manulife and John Hancock. So it was great. They brought a bunch of experience with them, helped us, not just build the technology, but also, understand what the actuarial implications were to bringing this type of offering on, to help us with the pricing. So that gave us a really good, foot in the door. And it's an interesting company just from culturally the way they work. They're very innovative. They have like an annual innovation competition where all their actuaries prepare different papers and do a lot of analysis goes into it. A lot of analytical modeling as well, and they present it to their leadership team for the potential to win big prizes, and it gets a lot of people interested. And a lot of those ideas have become their new product line. So it's a very cool company.
Yeah, just as a side note, there are 38, there's this, constant battle that we kind of fight about, is Silicon Valley really ground zero? 38 states have startups in the wearable space. There are over 112 countries. Tel Aviv and different cities in Israel, South Africa, and then the United States and Berlin are the leading markets right now in the wearable technologies, ranging from contact lenses that measure glucose and broadcast those measurements to an app, to Fitbit and Garmin and some of the more traditional. It's also one of the technologies across the landscape of insurance-based techs that is really funded with a lot of grant money. I was surprised. It's a very high volume of grant money that goes into these. So the best types of innovation are those that are become platforms for future innovation. What kind of things are you considering, if you don't mind sharing some of them, as you evolve this program? We talked a little bit about loyalty programs and maybe expanding the device range, but why don't you fill that in?
So we've rolled out, since we launched about, I think it was 3 years ago, and it was a pretty basic program. Since then, we've added a healthy food component based on a bunch of nutritional research that we've done. And that actually gives people discounts as they buy healthy foods. They can also earn points within the program to help improve their status. And I think that's an area where there's a lot of opportunity for continued kind of evolution of the program. We did find it to be very important to make sure that the program was not rigid in nature, that we couldn't go back and change things as technology evolved. We need to be able to go back and make sure the program's based in science, and as science evolves, we're able to evolve it. So that's why we're not specific to Fitbit. We have Apple Watches, we have Garmin devices. Anything can really plug in. Android, iPhones, all that stuff can measure step counts. We're using that. More recently, we've
Interesting approach.
Yeah, it's really about being flexible. Mm-hmm. You can go and get step count. Based on if you hit I think it's 10,000 steps in the day, you can get 10 points. But you could check in at your gym. Go in through the app. It pings your phone when you walk into the door. Pings your phone 20, 30 minutes later, and if you're still in the same place, then you would get 10 points as well. You can't get 20 points by doing both, but
right.
So it's flexible, and it really can work with customers how they want to work with us, which is great because you don't necessarily know. And I think, even some of the morning sessions around distribution and sales and all of that stuff, it's really dangerous to assume that you can force a process on someone, whether it's a distributor or a customer. And I think that's where, having this ability to be somewhat agnostic to platform is really important.
Let me, because we can keep going back and forth, and because I've got a bunch of questions for him, but I don't want to take up all your time. So I'm going to crowdsource here. Does anybody have any questions on this? Yes.
Do you offer that program to non-policyholders? In other words, as a method to maybe attract new policyholders?
Not at this time. So the question was, do we offer the program to non-policyholders? And not at this time, but it's definitely something we've toyed around with, and I wouldn't be surprised if we did that at some point, just on a trial basis. But we haven't made any decisions around that yet.
Yes.
Analytic reports that might be individualized to your policyholder. Are you preparing those now with this data, giving back feedback to them as to how they're managing their health? Is that kind of stuff part of your program?
So the question was around analytical feedback and how we can prepare reports. You can almost think of when you get your electrical bill and it says you're within the top 90% in your area on your efficiency or something, or maybe for some it's not quite as high. I have an old house, so I'm actually probably on the low end where I end up. We don't do anything specific right now, but we're just starting to get our heads around some of the data we're collecting. It is pretty generic. We're not trying to collect too much creepy information. But there is good information there around total step counts being made. We can see the differences between devices and how people engage. We've added this Apple Watch program more recently, and we've seen a significant impact in how people engage with that device versus some of the other devices. So we'd expect better mortality outcomes from those people as well. But we haven't started to feed it back to our customers yet, although it's definitely something we could do in the future.
Yes.
You mentioned distribution a second ago. So how has the sales force done because it is a slightly nuanced product. So how have they done adopting it and selling it and embracing it?
That's where we've probably faced the biggest challenges on getting distribution adoption. We know that customers love it. We have customer research feedback. We have a growing D2C business where we're seeing much higher adoption rates. But we know this works in an agent, even in an independent agent space. In both South Africa and the UK, that's how it's being sold. And we have seen significant growth. I mean, it's still very early days for us, 2-3 years out with something this new. You can picture, though, if you think about how do you sell insurance today, where you go in and you start talking about, well, when you die, you can protect your family. This could allow you to totally transform the conversation. Hey, I've got this program that helps you live a rewarding, healthy life. It's going to help you live longer, and it's going to protect your family in the event of untimely death. It's almost like you can talk about all of the benefits of this coverage more so than just the death protection. And it's actually going to benefit them both in price and they're not going to be any worse off for having this. So.
How is it, what types of policies are you engaging with for this? Because I'm thinking of sort of a classic whole life or universal life product. The price is the price. Are you giving annual reductions in price? How does it work mechanically?
Probably don't want to spend too much time on mechanics, but we have it on both term and UL, indexed UL, variable. I think we have it on our variable UL, yeah. So it's on almost all of our products at this point. On our life products, we don't have, we don't sell actively any annuities or long-term care at this point, or disability. And so we haven't looked at it there, but on a term product, it's a non-guaranteed premium, right? So we have to send an illustration with it, which is a bit of a complication, but most of the time people are getting quotes anyway, so it's just a bit of a change to the process or a more formal, document you have to go out with. On a UL product, it's not a change in your cost of insurance charges or anything. It's a non-guaranteed discount that, or a credit, I guess, is the way to, not a discount.
It was interesting, too. I was just in California and spent 2 days with a workers' comp carrier looking at innovation activities, and Wearables was certainly the technology that got the most attention in their shop, from the idea of incentivizing worker safety and then having additional loyalty through that. And there's that fine trade-off, and I think it's interesting how you all are navigating this between giving away the devices versus selling them, opening up non-insurance revenue streams. Also, what do you do in terms of flexible premiums so those rewards are there? And I have to give, I will tell you as I step back from an industry perspective and from an innovation perspective, I've got to give Hancock mad props for the way this is structured and for, quite frankly, having somebody with an actuarial background leading the charge. That is not that's not a typical practice in insurance innovation teams, but it's a good one in every company or project I've been associated with where somebody from an actuarial background is in a leadership role. So I want to give them a plug for having Matt lead this, and also just say that it's just a good note to take. Other questions? In the back, and then all the way in the back.
Hi, thanks. Brooks Tingle, who was really leading the charge on this, is now CEO of the personal insurance division. How do you see what he's done, or the fact that you have a champion for this project in such a notable position now, maybe sort of implementing these kinds of digital solutions in other ways across John Hancock's offerings?
Well, I think that's actually what was so important was, I was very involved from a technical implementation, doing the mortality analysis, and it's been nice to have kind of, I have an actuarial background, but I spent most of my time doing research and development, working on these types of projects. So I've kind of been able to carve my own path to help out, and when programs like this come up, I get involved in really making sure it gets implemented. And I think that's what Guy was talking about, is to actually know how to implement something across the business. It's generally not an outsider who can do that. It's someone who's been in the business, who understands where the business makes money from, and actuaries are really well suited to do that. But you do need a champion, especially at the executive level, and that's what Brooks really did. Was he very quickly saw that this is very transformational, it's disruptive, and it's a way to totally change the landscape for the business. You think about what's awful about insurance is it's a boring product to own and it's an awful product to buy. I mean, so we've tried to change the ownership experience, and now we're moving on to the buying process, which I think is what a lot of companies are looking to do, which is great. I think the more the industry can change its image, the better. It helps all of us.
Just to comment on that too, in my experience, the innovation can get launched and championed from the top, but it lives or dies. It thrives or doesn't in middle management. And it really is about managing that talent throughout to get the buy-in. No question a strong leader can make a difference, but it won't be sustainable unless everybody's taken into account. In the very back.
Yeah. First, you look good in that airplane chair. I think you need to get one, man. You look pretty comfortable. Okay, my question.
Too much
Guy, you talked a little bit about implants in other countries looking into that. What about nanotechnology or the possibility of ingesting a nanobot? Has there been anything the industry's been looking into that?
In some very interesting places and some very scary places. So yes, disease recovery and treatment has absolutely been done with programmable medicine, so mechanical medicine. In terms of attacking a disease before it strikes, essentially rewiring the code, the DNA, has been done not so much with nanotechnology, but with more biologic chemical. There is an important thing to keep in mind. We're way past growing chips instead of manufacturing them on computers in general and technology in general. And so I have seen very effective projects on, not in the United States, but on cancer prevention and cancer treatment with ingested mechanical devices. In terms of ongoing monitoring or assessing a propensity, that's still at the basic scan stage. PillCheck out of Canada is a company that is doing amazing things, aligning people's medicine with their DNA. And of course, 23andMe, and there's others. But most of that work's being done out of Israel.
I think that's one of this, not putting the program that we have aside and all of that, this wearable space is so cool that, we probably are on the precipice of a dramatic change in life expectancy, 10, 15, 20 years, if we can really start to change the way these devices can help diagnose and treat different conditions, especially when you combine what's going on with technical devices with the research into genomics and the bio or the gut, right? I'm not an expert in any of that, but I think those three things together will really, with the program type mentality of being able to change people's behavior, you can capture the nature and the nurture parts of different illnesses, and using artificial intelligence and things like that, it's all going to come together at some point. It's just a matter of when everything converges.
Yeah, let me just offer up a quick framework on this whole notion of insurtech for a second, because wearables can fall into that or not fall into that. Through the activity, I know you've probably all run into Innovator's Edge. So on that software community, we're tracking about 38,000 early stage firms that span 175 countries. Roughly 85% of those don't have insurance identified as a growth vertical. Now, to the degree that they're successful, and this is $350 billion in funding last year, if to the degree that they're successful, their whole goal is to eliminate the loss, to prevent it from happening. Medicine, vehicles, robotics, artificial intelligence. The companies that have experienced the most growth stumbled into the insurance industry, and it became their fastest growing platform because it was an application for their tech. The 15% that are essentially insurtechs, many of those are, of course, in the wearable field. And so as companies think about being innovative in a space like wearables, it's important to make sure that you expand that horizon to consider the implant as well as the wearable. I will tell you, as I sit here kind of comfortably, everything from here to here on me was manufactured on a 3D printer. And I can go in for an outpatient and have a device attached, which will measure steps, wear and tear on the device. I just have not quite found the incentive yet to do it. But that's how far that, and that was, so that's an upgrade from something that was put in 5 years ago. Other questions? Okay. We good?
Right time?
Right on time?
Yeah.
Right on time.
Thank you.
Thank you very much.
I feel like my question might have come off the wrong way.
Good
I didn't mean
discussion.
to diminish your involvement in the project. I was trying to ask you if you thought that, you know, having. Yeah, I know. That's the thing. I'm a reporter with Digital Insurance, and I've worked with Brooks on a lot. He's been my main point of contact as we've been monitoring Vitality now for 3 years. And I just was asking, it was more like, do you think that you'll see more of these sort of innovative things that you can, that it wasn't supposed to be about giving him credit. I'm sorry that it came
No,
out
no,
that
that's
way.
fine. That I think it was more. I don't know what his plans are, but I do know.
Since we're waiting to have that redone,
Yep.
do you want me to play some music?
That'd be part.
Very
Why
nice
don't I do a
session.
quick, like, we're gonna do a
Mike's on.
So we'll get started with the next panel momentarily. We've got to do a chair switch out, and then we'll get going. introduce you, and then maybe he'll be done, and then y'all can come up together. Does that work? All right, I think we're ready for the second panel, finishing up getting mics done, and we got chairs. So let me introduce our moderator, Paula Dierenfeld. She's a member of the Government Affairs Department of Nyemaster Good. Prior to joining the firm, she served in a lot of different government capacities. I think she covered every level of government, from Congress to state assembly to the governor's office. And she even currently serves as a mayor in the local community. So she, in addition to that, she serves as executive director of the Federation of Iowa Insurers. So Paula, I'll turn it over to you and the rest of the panel. Thank you.
I guess I have a mic. Thank you for that very nice introduction. I think I'll just invite the panel to come up because I will be introducing them one at a time as they make some introductory remarks. So, and they're still getting mic'd up, so hopefully our plane doesn't take off before they get here. I'm not going to tell you all that you're missing a really beautiful day outside.
All right.
It'll be nice into the evening hours. Well, it looks like we have everybody in their seats, so we're ready to take off. Do you have your seatbelts fastened?
Yeah, ready.
Great, we're ready to go. First of all, I want to just thank you all for coming to this session this afternoon and to welcome you. This is the session on trends in life and health underwriting. And we've got some of the best minds in the country here to talk to us about this topic and the exciting things going on in the insurance industry around this topic. So let's get started. First, what I'm going to do is I'm going to introduce each of the panelists one at a time, and they're going to share 5 to 8 minutes of information about themselves, about their company, and just kind of pique your interest about what more they might have to say. And then I'm going to ask them some questions to kind of get the conversation started. But what I'm going to ask all of you to do is you be thinking about your questions, because we want to make sure that you get out of this session what you expected when you came in the door, and even more. So be thinking about your questions. So we're going to start with Neil. Neil is Chief Underwriter for Individual Life Insurance at Principal Financial Group. As Chief Underwriter, Neil is responsible for underwriting Principal's life products in the retail and COLI markets. He also leads in underwriter training and quality assurance, and with medical department, vendor management, and reinsurance relationships. Neil is Iowa educated, having received his BS in finance and management at the University of Northern Iowa. Go Panthers.
That's right.
Neil.
All right, thank you very much. And thank you everybody for joining us. I am going to go through just a few slides talking about trends in underwriting, but I have to start with the qualifier. I really think the conversation today is more about trends in life insurance, because underwriting is really just a small part of what we're going to talk about, and I think some of the questions that Paula even has will illustrate that. But let me start with the life insurance gap. The industry today has about 60 million uninsured or underinsured individuals. There's about a $12 million insurance gap out there. We have to help close that gap for both the uninsured and the underinsured. Underwriting can be a part of the solution, and I'm willing to play my part, but underwriting can't be the entire solution, and it won't solve it on its own. We have to figure out other things. So what do we have to do? We have to figure out how to improve processes. And my other panelists up here are going to talk about that. They've got as much experience, if not more, than what I do relative to processing. So we need to talk about that. We've got to increase education and awareness. And what does education and awareness mean? Well, I think what it means is we have to get people to understand the value of life insurance. Why is it important to have life insurance? We talk a lot about, financial wellness, if you will, and the focus a lot of the time is on retirement. Are you saving enough for retirement? Well, are you preparing for the unexpected would be the question that I would pose. And so I think we have to do more relative to that. We have to create a stronger value proposition. And what I mean by that is there is a perception out there, and we've done some of our own research at the principal. There is a perception out there that life insurance is too expensive. You guys probably know as well as I do that a 30-year-old male, female, doesn't make any difference, who's healthy, gets the best rate class, could buy a 10-year term life insurance policy for $1 million of death benefit and probably pay less on an annual basis for that than what they'd pay for their iPhone. Certainly would pay less for that on an annual basis than what they'd probably pay in their monthly fees to the Verizons, the Sprints, the T-Mobiles of the world to have that plan. And people will sit in line for hours, if not days, to buy the next iPhone. And they'll happily pay $1,000 for it. But they won't spend a few $100s a year as a young individual who's healthy to protect not only themselves, but their family in the future. I don't understand it. I think we have to figure out as an industry how we can create this value proposition so that people will understand why they need to have it, why it's important to them, and why it really doesn't cost as much as they might think. We have to get them engaged, though. How many people buy a life insurance policy and never think about it again? How often as a company do we talk to our policyholders? Once a year, we might send them an annual statement. Maybe we send them monthly billing notices, probably not because everything's done electronically today. But as a carrier, what are we going to do to get people engaged? To see that life insurance policy as something more than just something I bought. I don't know why, I'll never benefit from it, but it was important, so I guess I bought it. So I think we have to figure out how to engage people. So how do we do it? We have to create an experience that they can get through other online or digital marketplaces. Why don't people buy life insurance? Well, part of it's because we don't make it easy, right? I'd do a show of hands, but everybody's hand would go up. Who buys anything from Amazon? How long does it take to get something you buy from Amazon? You can get things delivered on Sunday now, through the Postal Service, no less. The Postal Service never used to deliver on Sunday. So what we have to do is we have to create an experience that includes digital and mobile capabilities. We have to get faster underwriting decisions, and we have to get faster delivery of the product. We have to provide online advice and assistance when the consumers want it. Again, we've done the research. People may want to buy, but they want advice. They want to talk to somebody because they're not always certain what they want or why they need it, how much do they need. And so we have to be able to provide both online advice and assistance when they want it. But I think we also have to combine the elements of self-serve with the advisor. Everything we do is within the context of there should and could be an advisor involved at any point in time in the process. And I think that's really important. So we have to provide technology as a solution set, but we can't forget that insurance is sold more often than bought, and it's usually with an advisor who's helping someone make decisions. So you're thinking to yourselves, is this guy going to talk about underwriting or not? So now we'll talk a little bit about underwriting. Obviously, we have to meet our mortality expectations. But we have to improve the customer experience. We have to look for new ways to underwrite. And we have to do it while preserving the mortality expectations that we have. My job description at the principal has elements of profitability, sales results, and mortality results. I have to balance all of that. So I can't push forward and say, yeah, let's do this faster, quicker, easier at the sacrifice of mortality. It's got to be in combination with. So what do we do? We're going to leverage new sources of information or improved information from existing sources. Again, when I think about this, I think about the fact that in the 30-plus years that I've been in underwriting, we've been dealing with data. It's not always been structured, but we've been dealing with data. So we can go out and get new data, or we can take some of that old data, medical records as an example, and turn it into something that's more consumable. So improve it. Again, we have to structure it. We have to be more effective. We have to be able to use algorithms and rules in order to make the business flow through more quickly. We have to continue to streamline underwriting that can support fully underwritten mortality expectations. So we've got simplified issue products out there, and those are fine. Part of what we're trying to do at the principal through our accelerated underwriting program is to provide a streamlined underwriting experience that allows us to give individuals the products they want at the prices that they expect and get the mortality expectations that we had priced for. So I'm going to stop with that. I think my time might be up, and I'm going to pass the clicker off.
Well, thank you, Neil. That's a great way to set up the introductions for the other speakers as well as the questions that we'll have later on. So now we're going to move to Laura. Laura Boylan is the product owner for I knew I wouldn't get this, algorithmic underwriting at Haven Life, a Mass Mutual's in-house startup that's setting the pace for innovation in life insurance. Laura works with a team of software engineers to build technology that supports direct-to-consumer life insurance sales and underwriting. Laura is a graduate of Harvard, where she received her AB in applied mathematics, and Harvard is not in Iowa. Laura.
Thank you so much. I'm going to keep this short and sweet. My name is Laura McKiernan Boylan. I'm an actuary and the product owner for algorithmic underwriting at Haven Life. Haven Life Insurance Agency. Haven Life builds the software that powers digital sales of Mass Mutual's non-convertible term life insurance product with coverage available up to $2 million sold direct to consumer. We offer an affordable product and one of the simplest and easiest online application processes. Our application is online. Our new business software supports the fully online application, automated underwriting engines, and a human underwriting portal for Mass Mutual. Applicants apply online with a customized experience with applications, questions that are reflexive based on their medical and personal history. We order third-party data in real time, including ID verification, prescription history, and motor vehicle records. Those real-time connections support fluidless underwriting, which allows eligible applicants to receive a final underwriting decision in a median time of 43 seconds, including at standard and tobacco rates. Other applicants go through a simplified paramedical process with fluids, and after labs are completed, the median time in manual underwriting is less than 6 days. So we're continually working to refine the application experience, and one of my favorite features that we rolled out last October is the ability for applicants to customize their product selection features, their face and term, after underwriting is completed, so that they can choose a product that really meets their needs and their budget. And at Haven Life and Mass Mutual, we bring together the best of technology and industry experience to provide a best-in-class customer application experience. We're constantly iterating and improving our process, and we are trying to make the life insurance buying experience as painless and affordable as possible. Thank you so much. I look forward to the conversation we're going to have.
Thank you, Laura. Moving on to Jason. Jason Andrew is co-founder and CEO of Limelight Health, a provider of mobile enterprise technology for the health insurance industry. Limelight Health offers mobile cloud-based technology that enables enterprise companies to simplify employee health benefits information and streamline the proposal, decision, and renewal process. Jason has had a long, impressive career working with Silicon Valley businesses, including many startups. Jason.
Thank you. Sitting in these airplane seats, I can't help but think that the drink and snack is coming at any point, so I'm just waiting. But anyway, thank you for having me, and glad to be on the panel and get a chance to chat. I've been in Silicon Valley for about almost 20 years. Frankly, it's a little bit overrated. You guys have a very cool city here. I like it a lot, and a great downtown. But we've had the fortune of that for a lot of that time working in distribution as an agent, and started my own brokerage firm. Prior to that, worked for a company that was sold to Hub, and all that was in distribution. Put together some large pools that were pulled together and had to get all the benefits put together. And two of the items that I want to talk about today are really about items that I'm excited or passionate about with what our company is doing, but more broadly what we're interested in the industry overall. And so one statistic that I find interesting is CB Insights had put this out, and they have some great data. They said it's estimated that 30 or fewer manual processes account for 40% of an insurer's cost of doing business and 80% of customer activity. And so digitizing these processes can eliminate 25% plus of these manual labor costs. So think about that statistic for a second. And I want to go, if you would, just go on a journey with me for a second on just one of these manual processes. Let's talk about just the journey of a census. So if you work on whatever area you work on in employee benefits in the group space, and you think about having to gather census data simply to get a quote from a carrier, and the work that it takes to gather that information together, because typically if it's at the broker's shop, it's being housed in either a renewal that they receive in the mail from the carrier, or it might be in their CRM, but that CRM is typically not going to be connected to the bin admin system that is housing all the employees' data. And they may have another payroll system that is going to have yet different data. So the largest national brokerage firms and carriers have 4 or 5 different disparate systems that during renewal time, and now that we've shifted to fourth quarter renewals, the majority of the business is renewing in about a 3-month period. You have gobs and gobs of people that do nothing but go to 5 different systems to pull together the accurate and correct census. And often, we've worked with several of the largest payroll providers nationally. Often they have all the payroll data and will have to call their own customers and ask to make sure that the census data is correct because that system does not talk to the benefit system. It's a huge problem. My team gets tired of me talking about it, but I joke that out of probably 20 years of doing employee benefits, I've lost probably 4 years just reconciling census data. When we first started our first company, my business partner and I, we literally would be on the phone at night verifying stuff in a census, right? Just night after night, because you have to pull together the proposal and do all that. So that's just one of those manual processes. And if you think about your business, whether you're on the carrier side, whether you're on the brokerage side, whether you're on the innovation side, wherever you sit, you could think about the manual processes that you do. And it's a big problem that we have in the industry that I'm really excited about helping to solve and work at making that a better user experience. When we think about customer experience, I would also say, and we'll talk about this a little bit more, I'm sure, but I would also say that we have to redefine what customer means, because a lot of times, particularly I think from a insurer's standpoint, everybody wants to get to the end user, which is the employee or the employer. And again, I'm coming from a lens of looking at the group space. But if it's true that carriers spend about $50 billion a year on software, I would argue that the customer is everybody who's working, who's involved in that process, and those in distribution, and the employer and the employee. Because here's what happens. If you think of Covered California, which was the largest and most successful exchange that rolled out during health reform, when they rolled out, they spent an unforeseen amount of money in pulling it together. And then we had these massive wait times when it was first rolled out in terms of people getting through, and had to default towards, which is my next slide, fax and getting paper in, which is the predominant way it's done. But you think about the end user, the insured, their experience. But part of that experience is tied to, can they get somebody on the phone? And what's the experience of that person on the phone like if they're working in a legacy system and they don't have access to the right information? Or if they're trying to go to their sales executive or their underwriter and they're working in a 30-year-old system, what's that experience like? And so there's another stat that just says data exchanges are still done via antiquated technologies, Excel, fax, and disparate legacy systems. $250 billion a year lost in our industry through paper-based transactions, $15 billion in fax. In California, which is supposedly the most innovative state in the country, 95% of all the enrollments in the small group market are done via paper today. I mean, as much as everybody talks about EDI and online connectivity and Zenefits and let's go paperless, 95% it all is done via paper. I was having dinner last night with a professor at the speaker thing who, we do need some actuaries, so I'm serious about the interns. And he said, we were talking about this, and he said, are you kidding me? I literally at the end of the year with my employer have to get all my documents together to get the reimbursements through my TPA, and I have to fax the pages over to get my reimbursement. And so we were talking about this idea that in some ways it's out of the principle of the matter, you may be trying to get $100 back, but you want your money back. But you spend hours of time on the phone trying to make sure that faxes went through, that you can get somebody online, and it's crazy. So what I'd love to do is, as part of this is wouldn't it be fun if we had a conversation that started in Des Moines between regulators, which you do a great job of bringing together regulators, carriers, and startups, that really resulted in a substantial shift in how we operate. And one of those parts is in getting some data standards. And I talk about this a lot. I don't want to preach about it, but it's if in any other industry you can innovate. So if you're looking at starting a PayPal or a Stripe, you can connect to all the banks and you can focus on the user experience. In employee benefits, you spend the majority of your time just trying to figure out how to connect to every single player in the industry because we've yet to develop a set of standards that allow data to transfer back and forth, and it's very costly. So looking forward to the conversation. Thanks for having me.
Thank you, Neil. Are you excited to hear more from these folks? I think they're doing a great job so far. So, Neil, you've mentioned this already, that we have a serious life insurance coverage gap in the United States. Less people have life insurance than need it. Less people have life insurance than want it. You've talked about the fact that that the whole application process is intrusive, intimidating, time-consuming, so it's any wonder anybody has life insurance. So let's dig a little deeper. You've already made some comments about this, but tell us a little more about how we can change the process of purchasing life insurance. How can we make it simpler and quicker? What are the new and different ways there is to underwrite?
So you're right, and I apologize. I pretty much covered the question in my slides, I think, but we'll go deeper. Again, I think we really have to look at it from the very beginning. So when someone's thinking about buying life insurance, what's their ability to get the information they need? What's their ability to figure out what the cost is going to be? And so I think having, again, the digital capabilities, the mobile capabilities, however it is that people are working, we need to make sure we have that available. And then when they decide they want to buy life insurance, again, we've got to make it easy for them. We can't make them pick up a phone and call somebody. Now, if that's what they want to do, that's fine. But let's give them options. Let's let them apply online if they want. Let's let them use their phone if it's 3 a.m. and they're, sitting out on the back deck because it's, I guess, a beautiful morning versus night. Let's let them do it when they want, how they want. And then I think the other thing we have to do, and this really gets to the heart of the underwriting, is we have to figure out how we can underwrite them and make it feel better. And I'm all for collecting fluids because there's a tremendous amount of information that we can get from that fluid information. But I think the reality is we've got other sources of data that are out there today. Some of them commonly known to us. Again, others maybe not so much. Some of them may be a little bit scary, perhaps even creepy. When you start talking about some of the third-party data sources. But I think what we have to figure out is we have to figure out how we can start to pull this information together, how we can use algorithms and rules to allow us to make informed decisions and get somebody an answer quickly. 43 seconds, I think is what you said, Laura. We're aspirational around minutes. I'll take 43 seconds when I can get it, but we're aspirational around minutes right now. And then the reality is, if we could do it in 2 days, that's a heck of a lot faster than an average of 30 to 45 days that we experience today. And so I think what we have to do is we have to get comfortable with the fact that there are other types of information out there that we can use. And when I talk about comfort, it's got to be comfort not only from the insurance carrier's perspective, but I think also from the applicant's perspective, from the advisor's perspective, and even from the regulator perspective. So I think having an open dialogue about some of those opportunities and really trying to figure out where we can leverage them. And I'll make a final comment and then I'll be done so others can talk. But, I referenced earlier the $1 million policy. Well, the reality is we underwrite more than $1 million policies. We underwrite policies that go into the multi-million-dollar range. There's no reason why some of these capabilities that we're talking about can't benefit those types of policies as well. So it's not just about getting the low risk, super healthy young individual out more quickly. It's really about trying to figure out how we can get anybody's experience, whether they're 30 years old buying $1 million coverage or they're 55 years old buying $5 or $10 million of coverage. We've got to figure out how to make it better for all of them.
Thank you, Neil. Laura, maybe the same question asked a little bit differently. On your website, I was out looking at your website before we came today. You boast about making life, and presumably life insurance, less hard. How are you doing that? What new procedures, technologies, systems are you using to underwrite insurance?
Sure. We are, every day, extremely focused on the customer experience. That's the number one thing we talk about when we get to work. That's the number one thing that drives every decision we make, every new feature we implement. And so we're really trying to fine-tune every aspect that comes from education at the beginning, helping people to understand that life insurance is a lot more affordable than they probably think, helping them figure out how to make the decision about what their personal need is, and then once they've made the decision, making the application process as easy as possible. I've applied for a couple of life insurance policies myself. It's not the nicest or easiest. And so we really just try to think about, from the customer perspective, how can we help them to feel like they're making the right decisions, that it's not a horrible, painful process, and at the end of the day, they've done something to really protect their family. Taking a look at the life insurance gap more broadly, just taking a step back, I think, Neil, everything you said, 100% correct. If we look at the sort of financial stability, financial literacy in the United States, I read something online that said that 2/3 of Americans don't have $1,000 in their bank account. Life insurance is a critical part of every financial plan. It's critical for financial stability, but I think there's still some work that needs to be done more broadly in the life insurance industry and outside to help people understand how to build a secure financial foundation for their families. So, we're really trying to focus on financial education, financial literacy, exploring new products that will meet consumers' needs and really help them to meet the needs that they're facing. One of the things that I like the most, actually, about our term life insurance product, it's super simple. It's non-convertible. There's no fanciness. It's just exactly what you need to cover your family if something happens to you. And I think that simplicity is another way we can really support consumers and help them to really understand the process and understand what their needs are. There's a lot of complexity in life insurance. I'm an actuary. I sort of know how complicated those products can be. I don't think that that's what most people need. It's not the market that we're working with, at least.
So, Jason, I'm going to shift gears here just a little bit. Insurance in one form or another has been around for centuries. And you, as the other panelists up here, are probably feeling like the legacy systems that you have to deal with have been around for just as long. How can startups, and you've dealt with a lot of startups, how can startups work to make things better, faster, and more accurate, and bridge the gap between the digital age and what feels like the Stone Age?
Good question. And I like your title better, algorithmic underwriting. It sounds really awesome. We were talking beforehand about, whether or not algorithms would replace people, right? That was kind of one of the things, but which I think you said you don't think so in some part, so right? Maybe, but so look, I think the good news is it's happening. I don't think we have a technology problem, at least in this industry. We really, and again, I'm speaking with the lens from benefits. I think that property casualty is kind of a leading indicator, and then you've got life insurance, particularly individual life, that's typically ahead of benefits. And so if life is operating in 1985, then benefits on the group side is like 1968, probably. And it's really antiquated, but there's been substantial shifts in the last 4 years, and I think there's a lot taking on. Prior to Zenefits in 2012, I think it was, and prior to health reform, you couldn't get anybody in Silicon Valley to even talk to you about a startup idea in insurance. No joke. There was no one who wanted to talk about it or had interest. And I think one of the early investments was eHealth, which was in like 1990 something, and there hadn't been a great return for the investors in the Valley, and so they just shied away from insurance altogether after that, in terms of that. So I think everybody then got really excited or greedy, depending on how you want to look at that, when Zenefits kind of skyrocketed in the first couple of years, and all of a sudden insurance was like, wow, this is really exciting. And so then you saw over the next couple of years, every venture capital firm in Silicon Valley suddenly had about 100 people that were specialists in insurance. I kid you not. And so since that time, you've seen some things. In 2012, there was exactly one insurance carrier that had made an investment in any insurtech company. Fast forward to 2016, you have 130 plus investments by insurance carriers into insurtech startups in just that 4-year period. If you look at the same thing, as I just talked about with just VCs in general, in 2010, you had about 20 investments across all industry in insurance, all VCs. And then just in 2016, same time, you had 290 different investors investing in InsurTech, right? So just in a 4-year period, just a substantial shift. And then there's other things. Global Insurance Symposium, right? In Silicon Valley, Plug and Play, which I think a lot of folks from here have been going out there. There's a lot of corporate partners that participate. A year ago exactly, they didn't know anything about insurance. And so when Ali and Saeed started the insurance vertical last year, we were part of their second batch of InsurTech companies. They were just getting started, and now you see the executive teams of many, many carriers flying out there, and they've got operations in China, Japan, in South America, all focused on insurance. And there's a ton of money that's being poured into it. So I think on both sides, both on the corporate side, we're seeing insurance carriers. Our company was backed by Mass Mutual Ventures, Access Strategic Ventures, and in the most recent round, Aflac. And so you're seeing a lot of really strong interest in the industry to fix some of these challenges. And so I think the combination of the money flowing in, and then we're also seeing just in, I'd say, the last 14 months, a real shift in there's really kind of the leading edge carriers that are kind of, I would say, ahead of a lot of others that are making big steps to really modernize their tech stack. Whether that's internally or partnering with startups. And so I think that's really what's going to drive it. I think the third piece that I would say is just, I think that there's industry, LIMRA has tried for years. I know that Benefit Focus has done some work on it when I talk about data standards. I know the NAC, I think, has a conference coming up called Innovation Conference in a couple of months. But I think it's going to be a collection of regulators really working on helping build more data standards to focus on innovation. I think that's a key piece. And then it's going to take some of the top carriers agreeing and deciding that it makes sense for the business to agree on some standards and then continuing to have the money pour in.
So let's take that comment a little bit further. You mentioned regulators, and I see Commissioner Ullman standing at the back of the room. I don't know how many other regulators we have in the audience here, and maybe this question should go to them. But in this changing world of the insurance industry, what do regulators need to be doing differently? What do they need to stimulate some of that, do differently to encourage that innovation that we need in the industry? I'll just open that up to all of you.
I'll be brief. I think when health reform came around, love it or hate it, there was a lot of work that was done for everything that was taking place politically, right, on both sides, where everybody wanted to rip it apart, say it was horrible or it was good. Wherever side you landed on, what was really taking place was there was a ton of work by all the policy wonks and the regulators behind the scenes actually trying to make whatever we were trying to do work. Because you're talking about just a colossal waste of money with the fight back and forth. So there were all kinds of great people working kind of behind the scenes going, okay, we know everybody's saying this in the media, but here's what we actually need to do to get this, either enforce it, not enforce it. And a big part of that was just education. And at first, everybody was scared to death. I mean, every meeting we went to, we did a ton in DC and in Sacramento and talked with folks, but in those first meetings, it was like, there was so many misconceptions around whose distribution, and are we going to disrupt this, we're going to change that. And until you could get folks educated and just to have the conversation, there was very little progress that was being made, and it was a colossal waste of time. And I think there needs to be something similar that takes place. So NAIC is having an innovation conference. Awesome. Invite startups, get carriers. I think it should be a collaborative conversation and real openness to go, how do we really innovate? Because it's a great opportunity and time.
I would add on, Paul, I think, and we've had some experience at the principal recently working with the state of Iowa. Let them see what you're working on. Let them touch it. Let them feel it. Let them kind of dig in under the covers a little bit. So I think education is great, but I think to sit here and believe that we can talk somebody through some of the solutions that we're trying to provide today is probably short-sighted on our part. And so I think part of what we have to do as carriers is be willing to go to the state regulators and say, look, this is what we want to do. And if you want to try it, here it is. And maybe let them, again, play with it a little bit. And I think that will help us in our efforts to try to get this commonality of thought moving in the same direction.
Laura? Sure. This is something that, obviously we're really committed to the customer experience. We're really committed to ensuring consistency, fairness, clearness. And so from our perspective, the regulations, the model laws are really important. And we think about them in everything that we do. We operate sort of almost more like a software company than a life insurance company, and that's really interesting in a whole bunch of ways. We move extremely quickly. We're very lucky to not have to deal with legacy infrastructure. And so we work in an agile environment. We do 2-week sprint cycles. We like to turn things around really quickly. And from my perspective, one of the things that's really challenging is the conversation with regulators happens once a year, once every couple of years when you get your filings approved. I would love to see a world where we could sort of chunk that out a little bit and do it more iteratively and maybe have the touch points be more ongoing, more regular, and do things in small steps. That's the way we work, and it's been really successful in helping us to move forward quickly. So we can try things. If it doesn't work, we can switch gears, try something else. And one of the fun things, especially at my company, is a lot of our software engineers don't come from life insurance. And so they just ask questions about why we do things the way we do, and sometimes they're really insightful. Just to give a quick example, somebody once asked me why we ask for parents' age on an application. I said, oh, that's how you do it. It's on the application. You have to ask it. And then they're like, yeah, but why? And that was just really interesting. So I think we did take it off the application. So I think bringing in, more perspectives and broadening the conversation really brings a lot of value and helps to identify gaps and things that just don't make that much sense when you take a step back.
I have a couple more questions, but why don't we see if we have any questions from the audience at this point?
So it would be really interesting to know, you both, I think Neil and Laura, is it? Had discussed with your programs that if you're eligible, you can go through a more expedited process with whether it's accelerated or algorithmic-driven underwriting. What percentage of your customers roughly go through that? And for the ones that don't, kind of what's missing to be able to get them through on a more instant or non-invasive process?
That's a great question. So our program is open to clients age 18 to 45, up to $1 million in coverage. And we're not at 100% fluidless eligibility. I don't think that that's somewhere realistically we're going to get. We continuously try to make incremental progress toward getting that number up as high as possible. I would say one of the biggest drivers that makes it difficult to make those decisions is prescription history. Sometimes that comes back and tells a different story than what we see on the application. So that's something that we're really trying to work on.
Yeah, I would say from our perspective, so our accelerated underwriting program is designed for individuals 18 to 60 applying up to $1 million of life insurance on any of our retail life insurance products. So we're not limited to just term insurance. Our goal is, if you will, to identify those risks that we can confidently classify as a best class preferred or preferred risk in the absence of having to get fluids and physical measurements. And if we can get 50 to 60% of those individuals that can go through our process, then we feel like we've been successful. I will tell you that our numbers sometimes go lower than that, sometimes go higher than that. That's a whole nother conversation relative to agent behavior, if you will, because that dictates a lot of what happens. But the good news is, for those individuals that qualify, they get approved in a matter of minutes, usually have a policy within a matter of days. For those individuals that don't qualify, then we just continue down the normal underwriting path. So no one gets denied insurance unless they've got major medical histories that would have made them an uninsurable risk anyway. So no one gets denied insurance because of our process. It's just a matter of whether or not you're able to be classified and qualify for coverage in the absence of the fluids.
Other questions?
There was one down at the very end.
Got to get your running shoes on.
And then one back there, too.
One back.
Thanks. Jason, you talked about in one of your opening slides 30 or fewer manual processes. Can you highlight what some of those big, clunky processes are that make up that 30?
I can do my best. And that stat came from CB Insights, right? So it'd be actually a good question to dig into that. I should do that. But look, I mean, census management is a massive one. I mean, there are, that's huge. The other one is simply proposal generation. So you think about typically in the sales process, if you're selling mostly to employers, you're going to get 4 or 5 proposals because you're typically going to go to MetLife, Principal, Guardian, you're going to go to a number of carriers and they're going to send you their legally binding proposal, which no one ever puts in front of a customer, right? And then someone in your office is going to take that and put that together. And just that process of kind of getting, all the proposals from everybody, or if you're selling medical, you've got to go typically to a multi-carrier quoting system, or you're going to go, carrier site to carrier site. So that's just kind of in the sales process. Then in the renewals process, every carrier is sending out renewals by mail. That's how you're still getting them. So then you're talking about just the renewal system, and a lot of times the new business system is not connected to the renewal system. So there's tons of information that has to be transferred from one system to another, even within carriers, and then certainly within brokerage shops if brokerage house. And then if you think about the enrollment process, then you're just talking about paper that's typically, again, done offline. If you look at all the Ben admin systems, so the top ones, whether it's PlanSource, Employee Navigator, eCentral, some of the new ones like Flock, GoCo, the adoption rate across the board is about 5%. If it's like 10%, and you have some brokerage houses and some places that maybe are getting 100% because they've really made the investment to get their staff to get everything on there. But all the enrollments are done via paper. So typically you have a general agency or a broker or somebody who's scrubbing all the applications, which is just making sure the information is right, and getting that all into the carrier. And then there's a back and forth for a couple weeks because inevitably someone missed a social, someone left a kid off, and that causes all kinds of problems when it comes down to then just customer service, because now somebody calls in and they show up at the doctor and the child is not covered and they're in the ER freaking out. And they call customer service and they say, sorry, we don't see him on the app. And now you've got a whole other issue of somebody has to track down the facts that came in, where the kid was, and if they actually have coverage. So those are some. I don't know if that helps, but that's probably 10, maybe. 30.
I think I saw another question over here. And while the mic is coming to you, I didn't wear my watch, so somebody's going to have to give me a signal at some point. 5 minutes left. Great. Thank you.
Great session. Thank you. Laura and Jason, questions around license types and what type of regulatory license your firm holds or doesn't hold. Oftentimes, technology companies bridge over into soliciting business or getting into this kind of gray area around should we have an agency license or be appointed with a carrier or something like that, even though we're putting ourselves out there as a technology company. So could you just validate, are you a technology company or are you an insurance firm, or how do you describe yourself that way? And then secondarily, what kind of appointments do you hold or license types are you required to maintain?
I'm really glad you asked that question because it's something we talk about a lot to try to make sure we're really clear on this. Haven Life Insurance Agency is a subsidiary of MassMutual. We are a technology company. MassMutual, builds, prices, sells our products. They do our underwriting, and we are a part of MassMutual, the organization. So, we really focus on the sales experience. We're an agency, and they're the insurer. And that's a really important distinction for us to clarify.
We are a technology company. Interestingly enough, we are licensed in most states only because we aggregate data from medical carriers in addition to ancillary specialty lines that we then put on our product and allow folks to have a much better experience in terms of quoting and rating and underwriting and proposals and so forth. So in order to get some of that data from some carriers, we have to be contracted and licensed, even though we're not selling business or active. We're a technology company. But for that purpose, we have to be in some cases.
We probably have time for one more question if there is. Here we go.
I was going to try to combine these conversations and say, do you see in the future at some point near term perhaps, with all the data that you have, and I'm going to start with you, Jason, all the data you have on people within a group, and the medical data and the census data, and leveraging that with individual solutions, because you can do accelerated or automated underwriting, where perhaps a group, you're not only assessing the risk of the group based on individual characteristics for group insurance, but then pulling out people with individual solutions and automatically supplying an opportunity to purchase through the individual, sort of a consolidated thing. Do you see that in the near future? Is that long term? Is that even possible?
Yes, yes, and yes. I definitely think that one of the biggest lost opportunities is that you've got a large percentage of all of us get our benefits through our company, period. That is the largest insured market. So there's a substantial opportunity to cross-sell, upsell, and get in front of that. And I think what happens is, because everything is so fragmented, medical drives most sales, period. Because no one typically, unless you can't afford it, is going to go without health insurance, right? But you then kind of go down the line, dental, vision, life, in terms of most people's minds. So I think that if you can put more products in front of folks and a good experience at the time they're selling in a group, then you absolutely have the opportunity to pick up and educate in terms of more business. And then we're doing a lot of work around all those things. So the more data we get on, we're looking for a really good algorithmic underwriter. If anyone knows anyone who's looking, we need some folks like that. Because we see there's lots of opportunity to learn on the data, and right now it's all a lot of it is manually driven, but we see in the very near term what we're working on is being able to learn from all of that information to serve something up to you to make better decisions for all the users. So we've got users for underwriters, sales executives, brokers, like the whole ecosystem, and we want to give back good information to make better decisions.
And to give our perspective on that, things are pretty simple from us. We sell one Mass Mutual product. It's a term life insurance product. So that simplicity, I think, is really one of our value propositions and something we're trying to offer. There are certainly opportunities to look toward different product offerings in the future and how we can solve other needs that customers have. But I think we're very sort of choosy in what we put out there because we want it to be simple, we want it to be clear, we want it to be easy. So
let's catch one more question right here since I identified this gentleman.
Thanks. What's your views on where medical information and the old medical exam fits in with this? I'm particularly curious about Laura's thinking on this because, doing this entirely online sort of precludes, the old-fashioned medical exam. So where does that sort of enter into the process?
to clarify, we do have medical exams for some of our customers. The application process is online, and then there's a paramedical process for some people. It's limited, it's shortened compared to what it is normally. And for most of our applicants, that's really the only human that they have to interact with throughout the process. They do, of course, have customer support available for any questions, but it's definitely an important part of the underwriting for everybody over age 45 and for some of the younger applicants as well, to make sure that the data that we're getting and the application sort of tells the whole story.
I would say, what we're doing with accelerated underwriting today, again, is kind of a dipping of the toe in the water, if you will. Again, age 45, age 60, 500,000, million, whatever the limitations might be. Do I think that'll grow in the future and we'll get more comfortable underwriting higher face amounts in particular without the benefit of a medical exam and fluids? I certainly think so. Could I foresee a situation where we would ever issue a $25 or a $30 million policy on an individual and not have a current exam and fluids? As a veteran underwriter, that's hard for me to imagine, but I'm not in a position of never saying never because I just don't know. I do think that the availability of digital health data is really going to dictate what happens to the insurance exam in the future. If we can ever get digital health data really figured out so that it works well for us and we can get the kind of information we think we can get from it, I think that lessens the importance of the insurance exam, either at some of those higher face amounts. But as I sit here today, do I think that we will completely eliminate the insurance exam? I don't think so, but honestly, I don't know, because I wouldn't have guessed 20 years ago that we'd be underwriting individuals for best class preferred without blood, urine, physical measurements either. So,
Well, thank you. We promised you a great panel, and I think we delivered. Thank you, Neil. Thank you, Laura, and thank you, Jason. And thanks again to all of you for spending some time with us. I'm supposed to remind you that there is a short networking break and then another keynote coming up at 2:45. So thanks again.